5 undervalued REITs, but are they a buy now? We're going to run through every single one of these REITs, their historical performance. We're going to look at their dividend safety. We're going to look at some of their financial metrics. And as always, we're going to run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price given our margin of safety. And we'll have a quick look to see what Wall Street are forecasting over the next 12 months. So let's jump into it, and these are REITs that have been selected by the community. So the first one is Alexandria Real Estate Equities. Now over the last year, they are down 29%. We can see them trading towards the mid to lower end of the 52-week range. The yield is just above 4% with a forward PE of just under 30. And over the last 10 years, if you have been holding this company, you would be up 72%. Bear in mind, it doesn't include those dividends reinvested. And we see their all-time high back end of 2021 at $223. So let's take a look at this company. Dividend safety, 76 score. It is safe. Market cap, 21 billion. It is a large cap company. Now, in terms of those recessionary metrics, well, last recession, they cut the dividend. They had above average growth, negative 6% versus the S&P's negative 12%. And they also significantly underperformed the S&P, negative 68% return versus the S&P's negative 55%. Dividend growth, quite nice. Last full year, 5%. It is above that 4% inflation rate. We always try to advise to get more. Last 5 years, 6%. Last 20 years, 4%. So on average, over the last 20 years, you would be getting an in-line with inflation increase year on year, and they have been increasing those dividends for the last 13 years. Now, in terms of dividend yield theory, for those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average, 4.18 versus 2.69. Another sign of undervaluation, the forward P to AFFO, 15.9 versus 25.5. Do bear in mind, though, we don't look at any of these models in isolation, and we will draw conclusions towards the end. Real estate sector, however, is 13.7, so slightly lower than that of Alexandria. Now, in terms of the free cash flow payout, yes, we do typically look to this. However, for REITs, it is a lot more volatile. So we look at the adjusted FFO, funds from operation. Below 90% is the target for these REITs, and we can see consistently below 90%, in fact, below 80%. 2023 at 76%, very nice. 2024 expected to go into the 60s, so this is positive. No real worries so far based on this information with regards to their dividend. Adjusted funds from operation per share, well, we can see it has been increasing. 420 in 2014, 651 in 2023. Now, it's not very consistent. We can see it did have periods such as 2020 where it did increase significantly and then fall. But over the longer term, it is moving in the right direction. Nice to note in 2024, they are expecting this to be 762. Sales growth, as typical for REITs, 5 to 10% for steady, moderate growth. They've been achieving that every single year, which is very nice to see. Some years that we see even better. The latest year at 11% is very strong. And what's quite important with the REITs is their adjusted funds from operation per share to grow as well. And we can see for the large part, it has been consistently growing at a very nice rate. In terms for those who like to see the numbers, well, their top line has gone from 730 million to 2.9 billion. Now, one thing that we'll just mention here before we go through this essential analysis is that REITs do dilute your position over the longer term, and we can see that here by issuing equity, 71 million in 2014, 171 in 2023. So just be aware, and as we go along, these companies do note how different companies, different REITs will dilute your position at a different rate, some faster than others. ROIC. Now, what we typically like to see for REITs, 3 to 5% to give us faith management are able to effectively allocate their capital. The last 4 years hasn't been the greatest at 2%. In fact, even before then, it was just touching 3%. This is one area for ARE that I would like to see them go back up to 3 as a bare minimum, more touching 5 to be more promising. Operating margin, yes, very nice to see. It is in the mid-30s to the mid-20s over the last 10 years. The only thing I would say, it has been decreasing year on year, so something just to keep an eye on moving forwards. Net debt to earnings before interest, tax, depreciation, amortization. Now, this shows us both the dividend safety as well as the balance sheet strength. With the number of years it would take the company to pay off all of their debt net of cash on hand. For REITs, we want to see below 5.5. Now we can see it has typically been above that, although we know over the last few years it has been coming down. 5.95 in 2023, still a bit too high. However, we can see in 2024 it is expected to be lower, so that is positive based on the information we have run through. The essentials dividend does look to be safe, the balance sheet does look to be okay, but there are some things just to consider moving forwards. Now, typically on the channel, we do deep dives, we do run through every single one of these models, which essentially comes to the intrinsic value. For today's episode of these REITs, we'll just jump straight into the intrinsic value, which for today's episode for ARE is $147. Don't forget, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos. Margin of safety then, this does depend on the investor. We start off with a minimum of 10%, which we use if it meets the criteria of a wide moat, strong financial metrics, good forward-looking data. For ARE, $132 at a 10% margin of safety, 15%, $125, and we can see at 20%, it isn't quite there yet. So for Alexandria Real Estate, we see between 15 to 20% margin of safety with the current trading price. In terms of Wall Street, well, they have a price target of $140, slightly lower than our intrinsic value, and they see upside of 15%. As we go through these different REITs, do let us know your thoughts in the comments, whether you are adding to any of these or whether they are on your watch list for a certain price. Also, bear in mind, different investors will have a different margin of safety, so depending on what you require, this may or may not be a current buy right now for you. So moving on to the next stock, we have Extra Space Storage, $144. It is in the midpoint of the 52-week range with a current yield of 4.5%, forward P to FFO of just under 18. Over the last year, well, you would be down 13%. Over the last 10 years, you would be up a nice 212%. But do bear in mind that we can see the all-time highs was sitting around $227 back end of 2021. So in terms of the dividend safety score, it is 80. It is safe. Market cap 30 billion. It is a large cap company. Now we can see from the last recession, they did cut their dividend. They had above average growth, but they also trailed the S&P with a negative 66% recession return. Dividend growth, nice to see, 8% just last February, so we should be expecting an increase over the next few weeks. Double digits over the last 5 years, double digits over the last 10 years. Very, very strong, very positive for investors. And we can see they have been increasing those dividends for the last 13 years. Now, in terms of dividend yield theory, we have that sign of undervaluation, 4.51 versus 3.36. We also note the forward P to AFO is below 18.3, the 5-year average of 22, so a double sign of undervaluation. But we note the real estate sector P to AFFO is lower at 13.7 than that of Extra Space Storage. So let's take a look at the payout ratio. Now we can see the data that we have available for 2022 and 2024, that it is below that 90% level. So it isn't too bad. Even 2024 at 83%, we can see the dividend is safe alongside that dividend safety score of safe. Now, adjusted funds from operation, it did go from 212 in 2013 to 890, but we do also note 2024 is expected to come down, so something just to bear in mind moving forwards. In terms of sales growth, well, 5 to 10%, very nice to see. It is increasing their top line very rapidly because over the last 10 years, when we come to analyze this company, it has gone from 530 million to 2.32 billion. Shares outstanding, remember what I mentioned earlier, REITs do dilute your position, but when we compare Extra Space Storage to Alexandria REIT, they do dilute your position at a slower rate. Now let's take a look at the ROIC. Nice to see, consistently high. In fact, 6 to 9% over the last 10 years. It has been increasing, although we do know in 2023 it is expected to drop down to 5% when that annual report is released. Nonetheless, that is at the upper end, so that is nice to see in terms of the ROIC. Operating margin, not only is it very positive, very strong, but we also see it increasing over the last 10 years. 55% in 2022, 2023 expected 52% is still very strong for this REIT. Now, when we take a look at the net debt to EBITDA, just a few things to bear in mind. 5.5 is the maximum we ideally like to see. 2022 at 5.47 isn't the worst. It is pretty much straddling around that maximum, but we do see a bit of a red flag indicator. 2023 expected to be 6.67. However, in better news, 2024, they're expecting this to come well below to 4.54. So this is one area that you may want to keep an eye on moving forwards in terms of Extra Space's debt level. So let's take a look at the valuation for EXR, and as always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, you can click on that pinned comment below. So we start off with a margin of safety of 10%. We see a buy up to 155. We move this to 15%, we see it buy up to 147, and at 20% it isn't quite there yet. So for EXR, we see a 15 to 20% margin of safety. In terms of Wall Street and what they forecast over the next 12 months, their price target of $162 sees upside of 13%. As I mentioned, do let me know what type of margin of safety you look for REITs, whether that is company dependent or industry specific, as a lot of people will look to 15 to 20%. Some other people may be wanting a much larger margin of safety at around 30 to 35. The next REIT that we are looking at is one that is new to the channel, we haven't looked at before. It is Avalon Bay Communities. Now, over the last year, it is down 5%. Over the last 10 years, however, up 37%. And we see its all-time high sitting around $250. It is in the midpoint of the 52-week range with a yield just under 4% and a P to FFO of 16. Now, its dividend safety is probably the highest score from the REITs that we have analysed so far. Very safe, 98. Market cap, 25 billion. It is a large cap company. Now, in terms of those key metrics, well, they maintained the dividend during the last recession, above average growth, but also trailed the S&P. Dividend growth, well, they did announce an increase just last month, 3%, so you know how I feel. It is below that 4% I like to target. Over the last 5 years at 2% is very poor, but we do note consistently over the last 20 years, if you have been holding this company, they would be increasing that yield in line with inflation. And we can see they've only been increasing those dividends for the last year, as when we take a look from 2020 to 2022, they maintained that dividend, so just to let you know. In terms of dividend yield theory, again, that sign of undervaluation, both on the yield and the forward P to AFFO, with both the yield higher than the 5-year average and the forward P to AFFO lower than the 5-year average. And again, the real estate sector P to AFFO is lower at 13.7. In terms of the adjusted funds from operation, it is consistently below 90%. 2023 at 68%, 2024 pretty much expected the same, so no real worries. We can start to see why that dividend does look to be very safe. Adjusted funds from operation per share, very nice in my opinion, 646 to 975 in 2023. 2024 expected to increase, although very slightly, to around $10. Now taking a look at the adjusted funds from operation growth. Now we can see some double-digit numbers, some single-digit, as well as some single negative-digit growth. So again, just bear in mind it is fairly inconsistent in relation to that. But we do see their sales growth essentially around that 5 to 10% level, other than the 2019 to 21 period where it was very poor. So numerically speaking, we see their top line, it doesn't double, around 50% growth from 1.8 billion to 2.8 in 2023. And again, Avalon Bay, very similar to Extra Space Storage, they don't dilute your position as quickly as those other companies that we have analysed on this channel. ROIC, very nice to see it only dip to the lower end that we like to see at 3% in 2021. Otherwise, it is pretty consistently around the 4 to 5%. Operating margin, probably something to keep an eye on. It did have nearly 39 to 40% consistently year on year, which it has started to drop. It is 31% in 2023. This is one area for Avalon Bay where I would say for that margin just to keep a close eye on. In more positive news, the net debt to EBITDA has been pretty much falling consistently over the last 10 years. 4.82 in 2022, 4.31 in 2023, expected to go lower in 2024. Hence why we do see that very safe dividend score. No worries there. Balance sheet looks to be very strong. Management with that ROIC of 4 to 5% consistently looks to be an overall solid company. Now, in terms of the valuation, let's get into it. Let's get to the intrinsic value to see what level of margin of safety can be delivered. So we see around 196 as the intrinsic value. Now, margin of safety at 10%, a buy up to 176. So we do see it is pretty much trading at a 10% margin of safety. For those that like to see the numbers, at 15% around 166 and at 20% around 156. So at a 10% margin of safety, Wall Street over the next 12 months expect upside of 13%. They have the price target of $197, just slightly higher, a few dollars in fact, than the intrinsic value. Let me know if this is one that you have heard of before, as a lot of people do like it when we discuss new REITs on the channel, and this is one that we have just recently discovered and researched. The next REIT that we are taking a look at is DLR Digital Realty Trust. Now, this is a very popular one in the Dividend community, up 21% over the last year. Over the last 10 years, up 179%. Still hasn't reached its all-time highs at the back end of 2021 at $176. Current yield 3.4%, forward P to FFO of 22, and when we take a look, that dividend does look to be safe, a score of 80. Market cap 44 billion, a large cap company. Now, in terms of those recessionary metrics, well, they increased the dividend during the last recession, above average growth of 21%, and they actually outperformed the S&P, the first one from today's list, negative 27% to the S&P's negative 55. Dividend growth, well, we can see they haven't increased that dividend since March 22, although over the last 5 years and the last 10 years, we can see on average it does keep up in line with inflation, even though it is just marginally 1 or 2 percentage points higher. We also note they have been increasing those dividends for the last 18 years. In terms of dividend yield theory, well, we can see reasonable valuation, 3.38 versus 3.52. Forward P to FO higher, 23.2 to 21. So you could argue reasonable / some slight overvaluation. When we take a look at the sector P to FO, DLR is significantly higher, 23.2 versus 13.7. Now, when we look at the adjusted funds from operation payout, it has been consistently below 90%, although 2023 at 84% is a little bit too high, but it's nice to note it is coming down to 78% expected in 2024. Now, when we take a look at the adjusted funds from operation, $3.72 to $6. Over the more recent period, it has looked fairly flat. In fact, 2023, it is expected to drop to $5.84 when that annual report is released. 2024, it is expected to bounce back though to $6.22. So just a few different factors to consider. And we can see here, based on the adjusted funds from operation percentage-wise, in fact, 4 out of the last 10 years, it has been negative growth. Just something to consider. Although we do know the top line has increased very, very strongly over the last 10 years. 2023 expected 18%. So numerically, we can see the top line has gone from 1.5 billion to 5.31. Again, this company does dilute your position as a shareholder fairly significantly over the period, 128 million to 307. Now let's take a look at the ROIC. Not really great, just due to the fact it is decreasing. We want to see this the other way, or at least consistent. 2% over the last 4 years is a little bit of a worry, something that I would keep a very close eye on if I was a potential or an investor. And we can see here very similarly, the operating margin has been decreasing pretty consistently over the last 10 years. So there are a lot of things to consider with DLR. It doesn't necessarily mean it's a bad investment, but just some things that I am flagging to you moving on. Net debt to EBITDA, then 6.65 in 2022. 2023, nice to note, it is coming lower, as well as 2024, but we know even in 2024 it is still projected to be higher than the maximum we like to look at. Something just to consider though, as I mentioned. So let's get to the valuation for Digital Realty Trust. Is there a lot of margin of safety? Is there some nice upside, or is this a company that, whilst it may look undervalued, isn't one to buy? So the intrinsic value at $165, we can see the current price at $144. Margin of safety at 10%, we see a buy up to $149. At 15%, it isn't quite there yet. So we see around 10 to 15% margin of safety for DLR. In terms of Wall Street and their forecast, well, they don't see there to be too much upside, only around 4% with a price forecast of $150. Do let me know in the comments below, is this one that you have been adding on, you're just looking to hold, or does any of those financial metrics we ran through look like it could be a good opportunity? Personally, for me, this is the one out of the ones we have looked at so far that seems to be of less interest, just due to the price valuation as well as some of those red flag indicators I did discuss earlier. Now, before we move on to the next stock, just to let you know, we have released the latest article for our free weekly newsletters. It was talking about yield on cost, whether or not size matters. If you want to grab free newsletters every single week, last week we talked about an undervalued company with strong upside. The week before, we ran through our 7 golden dividend metrics screening undervalued companies. Click on that pinned comment below. So move on to the next REIT, we have Kimco Realty. Now this is in the midpoint of the 52-week range, down 12% over the last year, a yield of just under 5%, a forward P to FFO of 13, and over the last 10 years it is down around 3%. Now if we take a look at the dividend safety score, it sits at 70, it is safe. Market cap just under 14, it is essentially a large cap company. Now, recessionary metrics, they cut the dividend during the last recession, above average growth, although they massively underperformed the S&P, negative 82%. Dividend growth, nice to note, 4.3% just a few months ago above inflation. However, we can see based on the last 5 years and the last 20 years, they did have a dividend cut. And when we do take a look, they in fact cut the dividend in 2008 as well as 2009 and 2019. So they have only been increasing those dividends for the last 2 years. In terms of dividend yield theory, well, we see that sign of undervaluation, 4.76 versus 4.39. And we see here the forward P to FO is pretty much in line with the 5-year average of 16.3 versus 16.7. And as always, that real estate sector P to FO is slightly lower. So in terms of the adjusted funds from operation, we see it below 90% for the vast majority, 70 in 22, 78 in 23, 77 in 2024. No real worries with this payout based on this information. Adjusted funds from operation, very inconsistent, 109 in 2013, 120 in 2022. Yes, it has increased, but we do see a lot of inconsistencies and not very much growth. 2023 expected to drop down, 2024 expected a small increase. And when we look at this percentage-wise, we can see very inconsistent, very large swings, double-digit growth, double-digit negative growth. Now, when we take a look at the sales growth, pretty much a very similar story in terms of inconsistency. 2021 and 2022, yes, double-digit growth, but we also know in the more recent year, 3% increase to the top line. Numerically speaking, however, it has nearly doubled the top line, 870 million to 1.77 billion. In terms of shares outstanding, 409 to 618, so we can see it has increased the shares outstanding by about 50% over the last 10 years. ROIC then 3 to 5%. It has pretty much been 3 to 4 every single year. So the consistency is nice to see, but ideally we want to see 4 to 5% consistently year on year. Operating margin, nice to see that this company, this REIT, is very consistent around the low 30s. Always nice to see when the metric is positive and it is consistent. Net debt to EBITDA, very high in 2020 and 2021. It did drop dramatically to 5.95. Nice to see in 2023, it is roughly about the same, and even better to see in 2024, it is expected to come down to that 5.5 maximum threshold we want to see as investors. So let's take a look at Kimco Realty. The valuation, is there a lot of upside? And don't forget, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So margin of safety at 10%, we see pretty much at that current trading price. And when we take a look to Wall Street to see what they expect, well, they see around 16% upside over the next 12 months. So they do see this as a buy. As always, let me know your thoughts in the comments below whether or not any of these undervalued REITs do look like a good opportunity to buy. As I mentioned at the beginning of the episode, this was a few REITs that the community had requested. If there are any other REITs that we haven't covered over the last few weeks, then do let us know and we will take a look. As always, have a great day, catch you on the next episode, and take care for now.